Ladies and gentlemen, distinguished speakers, dear audience, it is my great pleasure to warmly welcome you all at the 2021 Lamfalussy Lectures Conference. My name is Edith Szalai and I am honored to be your host today. 2021 marks the 8th consecutive year that Magyar Nemzeti Bank, the Central Bank of Hungary, holds its most prominent international flagship event, the Lamfalussy Lectures Conference. During all these years, we became spoiled by hosting so many renowned economists and professors who honored us with their presence. But this year happens to be a bit different, as for the first time in its history, conference participants are compelled to meet in the virtual space due to the still ongoing pandemic. The Lamfalussy Lectures Conference, named after Baron Alexandre Lamfalussy, the father of the euro, as he is remembered by many of us, succeeded in becoming one of the key fora for European and global thinking on economic policy. This year, our distinguished speakers will discuss what the future holds for monetary policy after COVID-19, and they will also examine the evolution of public debt in this context. There are two important announcements I have to make about this year's program right at the beginning. This time, the conference is organized in a hybrid format, which means that some sessions of the event have already been pre-recorded and others are being live-streamed. And despite the original plans, Mr. Barnabás Virág, Deputy Governor of Magyar Nemzeti Bank, is opening our conference on this special occasion. Ladies and gentlemen, let's watch together Mr. Virág's remarks. Deputy Governor, the floor is yours.
Honorable guests, dear colleagues, ladies and gentlemen. It's my pleasure and honor to welcome you today to the 8th Lamfalussy Lectures Conference, which is the first one in its history to be held online due to the current circumstances, and it is dedicated to the challenges caused by the COVID-19 pandemic. The goal of the Lamfalussy Lectures Conference series is to provide a platform for prominent professionals to discuss and share their views on global economic policy and monetary policy. The COVID-19 pandemic has caused an unprecedented economic and social disruption around the globe. Several countries have experienced an unseen decline in their economic activities, and most have introduced strict lockdowns in the hope of curbing the spread of the virus. The pandemic has posed significant challenges to the policymakers. In order to reduce the negative economic impacts, fiscal and monetary authorities have engaged in large-scale measures such as job protection schemes and government securities purchase programs to support the economy. The COVID-19 crisis has changed the world operates with potential shifts that will outlast the pandemic. In my opening remarks, let me briefly summarize in 3 main points what central banks in the future will look like. Point number 1. We will be witnessing closer cooperation between fiscal and monetary policies. It has become clear during the past crisis that the optimal policy mix can only be achieved through continuous communication and cooperation between different branches of economic policy. In Hungary, for instance, the government introduced tax reliefs and job protection measures to alleviate the situation of firms and workers as pandemic erupted, while the MNB, the central bank, has taken a series of targeted and coordinated measures to provide all economic agents with the required amount of liquidity. As a result of these measures, no financial turmoil has emerged at any point in any submarket, while an appropriate amount of credit was consistently available to prevent a creditless recovery. We have learned that successful economic policy implementation hinges upon the cooperation between fiscal and monetary policy. Point number 2. The second characteristic we will see is the expanding central bank balance sheets. A large-scale attempt to support economic growth can only coincide with a dynamic growth in the central bank balance sheet. This is especially true in uncertain times, such as during the Covid-19, which explains previously unseen balance sheet growth since the onset of the pandemic. Central bank balance sheets have expanded to record levels due to the asset purchases and other liquidity providing measures taken against the negative economic effects of the pandemic. In Western Europe, this was rather necessary to secure the stable financing of state budgets amid extraordinary measures taken by the government. On the contrary, for Central and Eastern European central banks, this was rather an opportunity to support the crisis management of governments. Between 2013 and 2019, the MNB has preserved its monetary policy room for maneuver by keeping the size of its balance sheet low compared to many other central banks. This has allowed the MNB to launch its government securities purchase program to maintain a stable liquidity position in the government securities market and strengthen the effectiveness of monetary policy transmission. A continuous presence in the government bond market means a larger central bank balance sheet going forward, which will be the new normal in the future. Point number 3. Thirdly, central banks will have a long-lasting presence in the government securities market. Central bank purchases in the government securities market may be necessary even after the COVID-19 pandemic ends. However, the objective of government securities purchase program is not to finance gaps in the budget. A continuous central bank presence ensures the smooth functioning of the government bond market. This improves the monetary transmission, which in turn contributes to the primary central bank objective of price stability. Supporting sustainable growth, which was the main focus of last year's Lamfalussy Lectures Conference, may become a priority in several ways, and central banks should also be involved. A lasting central bank presence assures long-term growth that is also sustainable by keeping long-term interest rates from rising too high. Central banks can also contribute to sustainability by promoting green finance and embracing digitalization, two areas where the MNB intends to be a pioneer in. However, central banks should avoid the example of Japan, where monetizing public debt through general quantitative easing has resulted in serious side effects with respect to stability and inflation. Instead, targeted money creation is needed, which can be used to address the most pressing problems of the 21st century. Debt will always remain debt, while deficit will always become debt. The winners of the next decade will be those who draw the appropriate conclusions and find creative, wise, and courageous new solutions. To conclude, there is a growing awareness that the modern central bank is expected to contribute to prosperity in the medium term. For this, not general but targeted money creation programs are needed, because they are more sustainable and can secure the financial soundness and stability in a broader sense. The objective of this year's Lamfalussy Lectures E-Conference, organized for the 8th time, is to provide an overview of what prominent economic experts of the world think about policy challenges during and after the COVID-19. This forum provides a platform for discussions, and some of the open-minded solutions may also emerge, which we so much need. I would like to convey my very best wishes for a successful and pleasant e-conference.
Thank you, Mr. Virag, for setting the stage with your insights for some fruitful discussions. But before we turn to our speakers and panelists, I am honored to introduce some festive moments to you. Ladies and gentlemen, please join us for the Lamfalussy Award ceremony. Let's watch together the presentation of the Popovich and Lamfalussy Awards, which has also been pre-recorded. Ladies and gentlemen, distinguished guests, I would like to warmly welcome on the stage the Deputy Governors of Magyar Nemzeti Bank, Mr. Barnabás Virag, Mr. Mihály Pattai, and Mr. Csaba Kandrács, and Director General, Mr. Barna Fömötör, for the award ceremony. Each year, the night before the Lamfalussy Lectures Conference is filled with joyful and proud moments when the Popovich and Lamfalussy Awards are presented during the Lamfalussy Gala. This year, unfortunately, the pandemic prevented us from celebrating in person. The gala had to be cancelled, but not the award ceremony. So let us celebrate now the two awardees. Deputy Governor Virag, the floor is yours for a short appreciation of the awardees.
Distinguished guests, dear colleagues, professors, ladies and gentlemen. The winner of this year's Popovich Award has built his work on 4 values which are also, in my opinion, key of success: stability, high performance, innovation, and leadership. He constantly proves that innovation is not a project, but a continuous development. As CEO of the Budapest Institute of Banking, his and the institution's goal is to provide high quality and up-to-date knowledge to the financial sector and to strengthen the financial culture through high-ranking education, or as he calls it, via edutainment. 2020 was an exceptionally difficult year for all of us. Economic and social difficulties have caused significant challenges which required instant responses from policymakers. Crisis management became the focus point of policymaking. The winner of this year's Lamfalussy Award excelled in crisis management. He has been steering monetary policy and financial supervision through the pandemic, which helped to maintain favorable financial conditions and ensured the appropriate amount of liquidity across economic sectors. Under his leadership, his central bank has launched its first asset purchase program, which supported the stabilization of the government securities market, and last but not least, they successfully entered the ERM2 mechanism last summer. But before we turn to our awardees, there is a sad moment we have to remember. The rationale behind naming the conference and the award after Baron Alexandre Lamfalussy was to pay tribute to the spiritual heritage of the father of the euro. Since his death in 2015, Magyar Nemzeti Bank was trying to maintain the contact with his wife and 4 children. Unfortunately, since the last occasion when we met a year ago to preserve Baron Lamfalussy's memory, we learned with great sadness about the passing of Madame Cochard, the wife of Baron Lamphalussy. Our deepest sympathy is with her children.
Thank you, Deputy Governor Virag, for the uplifting speech and the short introduction of the winners of the Popovich and Lamfalussy Award. Let me now turn to our awardees and find out who they are. The Popovich Award is named after the first outstanding governor of Magyar Nemzeti Bank and is given each year to a talented young economist under the age of 45 who, with his or her forward-looking attitude and dedicated work and research, contributes to the fulfillment of the mandate of Magyar Nemzeti Bank, strengthening the bank's respect and recognition. Ladies and gentlemen, it is my pleasure to introduce the winner of the 2021 Popovich Award. Let let me invite Mr. Gergely Fábián, Executive Director of Magyar Nemzeti Bank and CEO of Budapest Institute of Banking, the winner of the Popovich Award, to come to the stage for the award ceremony. The award is presented by Deputy Governor Barnabás Virág. For more than a decade now, financial stability is very much linked to his name in Hungary. He joined the MNB at the time when the banking sector most seriously burned its hands with the global financial crisis in 2008. Our awardee took major part in leaving banks' crisis legacy behind in the transformation of the sector and in creating the prudential regulation so that Hungarian banks were facing the COVID crisis well prepared and shock resilient. He was there when MNB's most successful lending program, the Funding for Growth scheme, was born and managed the program for many years, thus leaving a remarkable footprint in the financing of Hungarian SMEs. He and his team also had an essential role in coordinating the settlement and conversion of foreign currency denominated household loans, which was one of the most severe vulnerabilities of the Hungarian financial system that time. As CEO of the Budapest Institute of Banking, his team provides high-quality education to the players of the financial system. Mr. Fábián, the stage is yours for your remarks.
Dear Deputy Governors, dear Director General, I'm honored and humbled to receive the Popovich Award. I was a second-year graduate when I finished third place on the university study competition of the Magyar Nemzeti Bank. It was the ceremony when I decided that I wanted to work here, and here I am after 12 years of work at the bank. Thank you for my family for the support. I feel like every year counts as a double at financial stability. I'm very grateful for the great team around me. They are fantastic people. Many of them started to work with me for 5-8 years as juniors to grow into senior and lead experts. The development of this team is my biggest acknowledgement, and this is what I try to achieve at other teams. In recent years, for instance, at Budapest Institute of Banking, it's an acknowledgement of their work. I'm also thankful for my teachers and leaders, especially Governor Matolcsi, who sent me many times into deep, sometimes into really deep waters, from which I learned a lot. Finally, let me share you a story. When I was a junior analyst, there was an open day, and I gave a presentation about financial stability to the public in the Popovich room. After one presentation, a lady came to me with a proud smile, and she pointed to the painting of Mr. Popovich, and she said that he was her grandfather. This is my story with the eponym Mr. Popovich. And this is the moment when I realized that working for the MNB, it's much more than a job. It's a strong dedication to value preservation and value creation. This award also an encouragement for me to continue this path from value preservation with the Money Museum to value creation in the financial system, in statistics, and least but not least in education, where due to technology and sustainability, the reskilling and upskilling of people is crucial in the financial system and beyond. Thank you.
Thank you very much, Mr. Fábián. Congratulations for winning the Popovich Award. And now let's go on to the second award. Along with the Lamfalussy Lectures Conference, Magyar Nemzeti Bank also established its most prestigious recognition, the Lamfalussy Award. This international award is presented annually to recognize outstanding professional performance and lifetime achievements on the international scene that have an influence on the work of the Magyar Nemzeti Bank and on the international financial system in general. Ladies and gentlemen, it is my great honor to introduce the winner of this year's Lamfalussy Award. Mr. Boris Vujčić, Governor of Hrvatska Narodna Banka, the winner of the 2021 Lamfalussy Award. Please come up on the stage for the award ceremony. The Lamfalussy Award is presented by Deputy Governor Barnabás Virág.
Boris, congratulations.
This year's awardee is a great reformer, Following his inauguration as governor, he helped navigate his country out of the economic through caused by the European debt crisis and oversaw the strengthening financial stability measures. He has reformed his country's monetary policy framework, which contributed to keeping inflation low and allowed the national currency to remain stable against the euro. These achievements ultimately led to his country joining the ERM2 mechanism last summer. His country would not be at the doorstep of introducing the euro had he not played a key role in his country's negotiations with the European Union as deputy chief negotiator, gaining extensive merits in the process of the European integration of his country. He also plays an instrumental role in organizing the Dubrovnik Economic Conference, which features renowned economists and prominent policymakers around the globe. Mr. Boris Vučić had received his doctorate from the University of Zagreb in 1996. He had served 2 terms as vice governor for the Croatian National Bank from 2000 before he was nominated governor in 2012 and renominated in 2018. In parallel with this, he was holding the position of deputy chief negotiator in the accession negotiations from 2005 until Croatia's accession to the European Union. He is ex officio member of the European Systematic Risk Board and member of the steering committee of the Vienna Initiative 2.0. Mr. Vučić is also a member of the advisory committee of the Center for Financial Innovation and Financial Stability, Federal Reserve Bank of Atlanta, and board member of the Global Development Network. Ladies and gentlemen, it is a tradition in the history of Lamfalussy Lectures Conference that the winner of the Lamfalussy Award delivers the Lamfalussy Lecture. So now, keeping up with our traditions, let me ask Governor Vučić to take the floor for his lecture, and I kindly ask the representatives of the Magyar Nemzeti Bank to take their seats. Thank you. Governor Vučić, the floor is all yours.
Thank you very much. Ladies and gentlemen, dear colleagues, and all those that are following this ceremony online, as we all got used to these days. When colleagues from the Magyar Nemzeti Bank called to inform me that I have received the Lamfalussy Award, award for outstanding professional performance and lifetime achievements, I felt both honored and grateful. First, knowing the importance of the award. Second, knowing the person whose name the award holds. And I had the chance to meet him and know the man. He was really very impressive in my young days as a director of the research department in the central bank. And of course, knowing all the colleagues and friends who received the award before me. So thank you very much. When I thought of the topic of today's speech, as we also discussed, it turned that it is appropriate to address the monetary policy of the emerging market countries. You can call them small open economies. In any way, the central banks that do not print the reserve currencies in an environment of unconventional monetary policies of the world's largest central banks. First ideas, interestingly, resonated with some thoughts on the Hitchhiker's Guide to the Galaxy, a timeless novel by Douglas Adams. And there were several reasons why it occurred that way to me. First of all, as you all know, central bankers are a group of people who are skeptical about the thoughts of people who take the universe for granted. So I had to process the information through the solipsistic lens, very much akin to the one displayed by the ruler of the universe, a fictional character from the novel. Secondly, as we know from the Hitchhiker's Guide to the Galaxy, 42 is the solution for all our problems. The famous answer to the ultimate question of life, the universe, and everything. Even though we didn't know what the question was actually in the novel. That, in turn, somehow reminds me of the monetary policy today. It's been proposed as an answer to almost any problem, from lack of inflation lack of GDP growth, to rising spreads in the markets, lack of access to credit, inequality, pollution, and in my own country recently, even the earthquake consequences. Another interesting parallel to the novel is Don't Panic, the title on the cover of the novel, which was quoted by many after that. Arthur Clarke, for example, who said this was the best advice to be given to the humanity. And this became a standard piece of advice to the policymakers during the last couple of crises, great financial crisis and the one with the pandemic. Thirdly, Adams worked with the Monty Pythons before writing the novel. And regarding monetary policy in emerging markets in a negative interest rate environment, I thought, what would the Monty Python crew do? What kind of sketch would they film? And they would have probably filmed a sketch of somebody coming to a bank and getting paid from the bank window to borrow money from the bank. Well, potentially very funny in the 70s, but even they might have considered the idea a bit too crazy at that time. Today, extremely low interest rates appear to be a permanent feature of our economies. No one would have thought that just a few years ago. When Japan was first struck by a combination of low inflation and low nominal interest rates about a quarter of a century ago, we considered it to be a temporary phenomenon or maybe something idiosyncratic to the Japanese economy. Our thoughts on central bank policy rates converging to zero in Western economies about a decade ago were very much along the similar lines. Nevertheless, signs of falling interest rates have been with us for quite some time. We can observe the implacable trend in our standard statistics over the last couple of decades. Very recent research finds that the trend of falling interest rates covers a much longer period, spanning over at least 7 centuries. Falling interest rates seem to predate even the establishment of first central banks. Also, over time, the frequency at which negative real rates appeared has increased. And that happened regardless of the dominant monetary regime. Fiat money issued by a central bank or some form of specific monetary standard, such as gold or silver. It is interesting to note that the different writers recognized a concept of falling interest rates throughout the history, albeit often in a conflicting manner. For example, Marx turned a declining rate of profit into a cornerstone of his theory, a sort of a doomsday device built into the foundations of the capitalism. Keynes, on the other hand, saw falling interest rates, but not profit rates, as a means to advance a new, better form of capitalism. It is worth repeating his words from the general theory. I see, therefore, the rentier aspect of capitalism as a transitional phase which will disappear when it has done its work. And with the disappearance of its rentier aspect, much else in it besides will suffer a sea change. It will be, moreover, a great advantage of the order of events which I'm advocating, that the euthanasia of the rentier, of the functionalist investor, will be nothing sudden, merely a gradual but prolonged continuance of what we have seen recently in Great Britain, and will need no revolution. Well, today we don't see low interest rates as a doomsday device. Also, we don't see them as a panacea, as Keynes saw them. Actually, it's an interesting twist of fate that it is the reduction of investments as population growth slowed down and the nature of technology changed that is pushing interest rates down rather than an increase in savings. We also have recent evidence that savings rates remained robust due to the rising rich savings glut, rather than an increase in general living standards. Also, a growing portion of the world's excess savings is generated by Far East economies, with capital flowing upstream towards richer economies. Further on, the impact of low interest rates on inequality is far from straightforward. Various channels operating in different ways, and many commentators blaming them for the rise in inequality, particularly inequality in wealth. Low interest rates also interact with the economy in a complicated manner, with some evidence of a negative impact on productivity growth, which is popularly often referred to as zombification of the economy. The most important negative side effect of low equilibrium interest rates implies that policy rates may often hit the lower bound, regardless of whether we consider it to be zero or slightly below zero, thus restricting the ability to pursue countercyclical monetary policies. Keynes was very well aware of that effect as he developed the concept of the liquidity trap. To overcome the problem of the lower bound on policy rates, central banks in major advanced economies have pursued APPs, asset purchase policies, in the context of quantitative easing and forward guidance. Until very recently, such policies have been firmly confined to a small batch of large central banks that issue reserve currencies. However, since the COVID-19 induced crisis, about 20 central banks from emerging markets engaged in APPs, a practice they have before steered clear of. Indeed, questions on the reasons for emerging market central banks to engage in APPs, their future plans, and sometimes the difference between the global financial crisis and the current episode, features prominently in almost every conference or investor meeting I have participated in over the past few months. The main reason for the emerging markets to initiate APPs is obvious with the benefit of hindsight. They were successful. Asset purchase programs, in principle, operate through several channels. The bank liquidity channel works through higher bank reserves, which expand loan supply. The portfolio rebalancing channel increases asset prices as investors divert proceeds from asset sales into alternative assets. And finally, the signaling channel reinforces expectations and future accommodative monetary policy. Early evidence confirms that APPs indeed worked in emerging markets in a more or less similar way to their mechanics in advanced economies. Such policies reduced bond yields and improved financing conditions for the domestic economy. Their impact on equity prices was less pronounced, but it can be argued that the portfolio rebalancing channel is not as important in emerging markets due to less developed capital markets and other types of non-bank intermediation in the provision of financing to the economy. Also, the main goal of APPs in emerging markets relates less to pushing up inflation and much more to stabilizing the markets. One important reason why APPs worked for emerging markets arises from the benign international environment and compressed risk premiums. While the breakout of the pandemic triggered a reversal of capital flows to emerging markets in March 2020, this episode was very brief and capital flows quickly resumed. The spillover from massive asset purchase programs implemented by the ECB and Fed is probably the main reason why emerging market exchange rates did not react much to the announcement and implementation of APPs. Comprehensive assessment of asset purchase programs would also have to take into account the self-selection of central banks. Even as the ranks of central banks implementing APPs swelled, still only a small minority of the world's central banks engage in such programs, presumably in countries with stronger fundamentals and lesser macroeconomic vulnerabilities. Finally, APPs in emerging markets were on average quite modest in size, which has kept the risk at bay. The Croatian National Bank implemented one of the largest asset purchase programs amongst the emerging markets last year, worth about 5.5 percentage points of the GDP. But even that was roughly only half the size of the ECB's program in the same year. In our case, entering into a currency swap arrangement with the European Central Bank, and the subsequent exchange rate mechanism to accession also helped to stabilize the markets and make APP a success. The recent evolution of monetary policy regimes in emerging markets cannot be taken for granted. Emerging markets do not issue reserve currencies, and they depend on international borrowing in foreign currencies. Jointly with domestic dollarization or euroization, this makes them heavily reliant on exchange rate movements, subordinating often other policy goals to the exchange rate stability. They in general have less robust overall policy frameworks with a lower level of credibility. And if fiscal dominance intensifies, APPs may not be able to counter increases of risk premiums without jeopardizing other policy goals. Also, deflation is generally not a problem in emerging markets. Elevated inflation still more often is. Emerging markets will remain prone to sudden stops and reversals in capital flows, which can trigger a currency and financial crisis. Their hard-earned license to pursue QE-type policies may not always be warranted. Such a policy will each and every time have to be weighted carefully against vulnerabilities and buffers such as foreign reserves, as well as global financial conditions and spillovers from monetary policies of major central banks. Asset purchase programs in emerging markets so far do not appear to generate major risks in the domestic economy. Unconventional policies of major central banks, which drive capital flows and credit cycles globally, are likely to remain a more immediate source of risk to financial stability in emerging markets. Taking everything into account, it is encouraging to see the broadening of the scope of monetary policy instruments in emerging markets. After all, while the interest rate channel of monetary policy may not be very strong in many emerging markets, they are used to the balance sheet policies. The balance sheet of Croatian National Bank increased over the past decade more or less in a lockstep with the balance sheet of the European Central Bank, just as excess reserves of the banking system increased in parallel. Although the fuel behind those increases have not been purchases of domestic securities, as was the case in the ECB, but rather the accumulation of international reserves, the bank liquidity channel has operated in the same way. In conclusion, let me refer back to Douglas Adams and the Monty Pythons. Despite the popularity and timelessness of his famous novel, Adams managed to reach his peak in professional sense only after he contributed to the Monty Python's Flying Circus in the early 70s. So, although I received the award for lifetime achievement relatively early, this encourages me to think that my career might also have a chance of surviving beyond the Lamfalussy Award, and I will do my best to continue my work very much motivated by the recognition I received today. Thank you very much.
Thank you very much, Governor Vujicic, for the insightful thoughts, and please accept again our heartfelt congratulations.
Thank you very much.
Ladies and gentlemen, following these festive moments, it is my great pleasure to introduce our keynote speaker today, who joined us virtually straight from Beijing, China. Mr. Gang Yi, Governor of the People's Bank of China and Deputy Director of the Financial Stability and Development Committee of the State Council. Dr. Yi joined the People's Bank of China in 1997 and has held numerous positions, including Secretary General of the Monetary Policy Committee and Director General of the Monetary Policy Department. He was appointed Governor of the People's Bank of China in March 2018. Governor Yi, the virtual stage is yours.
Dear Governor George Motossi, distinguished guests, it is my great pleasure to attend today's event. I would like to thank the Central Bank of Hungary for inviting me to talk on the Lamfalussy Lecture Conference. Last year, we had a difficult COVID-19 pandemic. The People's Bank of China rolled out many supporting measures, providing strong boost for the economic recovery. Our objective is to stabilize employment. Most employments in China are provided by private sector, especially the small and medium business. Our credit policy is designed in an attempt to encourage banks to lend more to micro and small business and private enterprises. At the same time, the People's Bank of China introduced two credit policy instruments to direct channel funds into real economy. These instruments aimed encourage banks to defer loan payments and grant preferential loans to selected micro and small companies without collateral. As of the end of last year, a total of 6.2 trillion renminbi, about $1 trillion deferred principal and interest payment was provided by banks, and an accumulative 3.4 trillion renminbi loan, about $0.5 trillion for micro and small companies were issued, which provided support to more than 31 million business entities. Overall, China's monetary policy has achieved good results and in supporting economic growth during the COVID-19 crisis. All lending decisions are made by commercial banks, who are responsible for the credit risks. The People's Bank of China provides some incentive tools for those banks doing loan rollover for at least 6 months. People's Bank of China gave a lump sum subsidy worth 1% of principal. For those who provide loans without collateral, PBOC gives them a 40% zero interest relending. As a result of proactive fiscal policy and accommodative monetary policy, the Chinese macro leverage ratio, which is the total debt to GDP ratio, climbed around 280% by the end of last year, which is a 20 percentage point increase over previous year, mainly due to the policy response to COVID-19. I expect that this year the macro leverage ratio will stabilize. Last year, we cut the interest rate about 50 bips. Right now, the 10-year government bond yield is about 3.1%, and overnight repo rate is less than 2% in China. Consumer price index measured inflation right now is about 2.5%. Renminbi exchange rate is at 6.5 renminbi to a dollar, and appreciated 7% against the US dollar last year. Going forward, China's monetary policy will, on one hand, adjust to new economic developments in a timely manner, and on the other hand, maintain policy stability to avoid policy cliff. We will strike a balance between stabilizing economic growth and preventing risks. and will keep money supply growth rate in line with the nominal GDP growth rate, which is a reflect of the nominal potential output. China will try to maintain normal monetary policy for as long as possible and keep our yield curve upward sloping. This year, we will continue to implement the two monetary policy instruments to direct channel funds into the real economy and use central bank lending and central bank discount window to guide financial institutions to support real economy, especially in the area such as agriculture, micro and small companies, and private enterprises. The Chinese leader announced that China will reach the carbon emission peak before 2030 and achieve carbon neutrality before 2060. The People's Bank of China will focus on promoting development of green finance. China's green finance had an early start and has developed a solid foundation. Now, the total amount of outstanding green loans in China amount to more than 11 trillion renminbi, ranked first globally. And the outstanding green bonds in China stand at more than 1 trillion renminbi, ranking China the second largest green bond market in the world. We will prioritize the overall policy design and planning for green finance, which will help to achieve the 30-60 objectives. To achieve this, we need to improve 5 pillars of the green financial system. First, revamp the system of green financial standards. Second, improve supervision and financial institution and disclosure requirement for green finance-related information. Third, enhance the policy incentive and discipline, create supporting tools for carbon emission reduction, and guide financial institutions to increase preferential loans to carbon reduction according to market principles. Fourth, continue to develop products such as green credit, green bonds, and green funds. Establish a carbon market and develop a carbon future market. Fifth, strengthening international cooperation on green finance, in particular with regard to the system of green financial standards. We shall strive to complete the China-EU Common Ground taxonomy as soon as possible. Thank you.
Thank you, Governor Yi. Indeed, some very impressive results and ambitions. Congratulations. After the interesting speeches, we now arrived at the most interactive part of our conference, the panel discussions.
The COVID-19 pandemic has brought unimaginable changes for 2020, manifesting in a new type of global crisis. The new situation poses new challenges for central banks, for monetary and fiscal policy. How will the mandates and the roles of central banks change? Has the boundary between fiscal and monetary policy moved forever? How much debt have governments taken on due to the COVID-19 pandemic? And will they ever be able to repay?
Our distinguished panelists joining us from 4 different parts of the world, Germany, France, China, and the United States, will share their views on the main theme of the dialogue, which is the future of monetary policy after COVID-19, with a perspective for public debt evolution. The discussion will be moderated by Mr. György Szapáry, Chief Advisor to the Governor of Magyar Nemzeti Bank, former Deputy Governor of the MNB, and former Ambassador of Hungary to the United States. Mr. Szapáry also worked several years at the International Monetary Fund. Mr. Szapáry, dear panel participants, we wish you a fruitful discussion. The floor is yours.
Welcome, everyone. We have an excellent panel today. Each panelist has 6 to 8 minutes to make introductory remarks, followed by several rounds of discussion. Registered audience can ask questions through the Zoom chat. So let me introduce briefly the panel participants. Philip Lane is a member of the Executive Board of the European Central Bank in charge of economic and monetary policies. Before that, he was governor of the Central Bank of Ireland. Before that, he was teaching at the Columbia University. Jacques de la Rosière, former managing director of the International Monetary Fund, former gouverneur de la Banque de France, and former chairman of the former senior advisor to the chairman of the BNP Paribas. Yang Yao is a professor and dean of the National School of Development at Peking University. He also teaches at the China Center for Economic Research and serves as its director. He's a member of China Economist 50 Forum. He has published more than 100 research papers in international and domestic journals, as well as several books on international economic development in China. Bill English joined the faculty of Yale University in 2017 after 25 years at the Board of Governors of the Federal Reserve System, where he had a range of positions at the Board of Governors, including the positions of Senior Special Advisor to the Board of Monetary Policy, Director of the Division of Monetary Affairs, and Secretary to the Federal Open Market Committee. At Yale, Bill teaches and conducts research on monetary policy and central banking. The purpose of this panel discussion is to look beyond COVID, while not questioning the need for monetary and fiscal expansion. To reboot the economies, one should look beyond the short term and look at what should be the monetary and policy framework in the years ahead. As food for thought, let me briefly show you 3 charts. The first chart, one shows the main central bank's balance sheet as percent of GDP from 2007, that is prior to the great financial crisis. The 2 crises led to an explosion of balance sheets as central banks pumped money to try to revive the economies. For the Fed, for the Bank of England, and for the Bank of Japan, it grew by 6 times or as percent of GDP. For the ECB, by over 3 times. Does this presage a revival of inflation? The second chart shows an evolution of financial assets and real wages. Divergence is striking as the money injected led to a rapid growth in the value of financial assets, far outpacing the evolution of real wages. This means a big increase in the inequality of distribution of incomes. One can look at that as Wall Street against Main Street. How much central banks should worry about that? The third chart shows the rapid increase in government debt. Can we assume that R minus G, that is real interest rate minus growth, remains negative for long, and debt servicing is not an issue? While there is still much uncertainty about the unfolding of the pandemic, this is not an excuse from addressing the policy implications. A lot of guessing is going on about the new role of central banks after the pandemic has been tamed. Inflation target averaging, yield curve control, monetary financing, are they here to stay? The Bretton Woods Conference was held in July 1944, when war was still raging in Europe, some 10 months before the end of the war. Do we need a Bretton Woods 2.0 to define the post-COVID international monetary framework? These are just a few thoughts on which panel participants might want to reflect. Let us start with Philip. The word is yours.
Thank you, and good afternoon, everyone. And let me say it's a pleasure to be invited to this event. As you know, the ECB also honors Baron Lamfalussy through the Lamfalussy Fellows Program at the ECB. And by the way, when I was in academia, I was a Lamfalussy Fellow in 2004. So I have that personal connection indirectly to his legacy. So today, I will certainly come to the longer-term implications or longer-term prognosis for monetary and fiscal policy. But along the way, I do want to talk about the pandemic response. Because what we see right now is a striking configuration of macroeconomic policies around the world. The large-scale but temporary nature of a pandemic calls for an outsized fiscal response that takes account of the shortfall of income for many workers and firms, the asymmetric effects across industries, depending on their reliance on physical proximity to customers, and a compelling case for smoothing the financing of the cost of extensive fiscal support over a very extended period. The optimal contribution of monetary policy in a pandemic is also analytically straightforward. The ample provision of liquidity to protect credit supply and the stabilization of markets, in combination with an accommodative monetary stance to counter the negative pandemic shock to the projected inflation path, which is generated by the large drop in activity levels compared to the pre-pandemic path of activity. At the ECB, we consider that the best way for us to achieve our monetary policy aim is to preserve favorable financing conditions throughout the pandemic period. Our commitment to preserve favorable financing conditions stabilizes markets, supports financial intermediation, and reassures potential borrowers, since the extended presence of the central bank limits the scope for the type of real financial doom loop that might otherwise be triggered by an adverse shock in the current environment. It also anchors the monetary policy stance. The amount of slack in the economy and the low levels of inflation expected in the latest macro projections make it essential to avoid any loss of confidence and crowding out of economic activity that would be generated by unfavorable developments in financing conditions. In overall terms, the ECB supports favorable financing conditions through our mix of policies. The already low level of the deposit facility rate, the forward guidance on the future path of this policy rate, our range of liquidity providing refinancing operations, most prominently the TLTRO program, asset purchases with the steady contribution of our APP, which is buttressed by the forward guidance that net purchases under the APP will end only shortly before we lift the policy rate, and of course our pandemic emergency purchase program, the PEP. Now, in terms of policy implementation, the Governing Council of the ECB routinely looks at a wide range of measures to gauge the state of financing conditions for all sectors of the economy, with a prominent focus on the conditions facing customers who depend on bank intermediated credit, as well as the conditions facing sectors that seek to obtain funding in bond markets. In a similar vein, a wide array of models and empirical methods is employed to assess the role played by financing conditions in determining the evolution of the economy and inflation dynamics. Naturally, the focus on credit conditions in the banking system on the one side and the bond markets on the other side is consistent with the main methods used by central banks in steering financing conditions, namely through the various types of operations we conduct with banking system counterparties and through outright securities purchases, which primarily focus on bond markets. Of course, other financial indicators also feed into the staff macro and inflation projections and are incorporated into the Governing Council's regular assessments of the appropriate monetary stance. The PEP plays an especially important role, given that it is expressly designed to respond to the pandemic shock. Thanks to its scale and flexibility, it underpins the crucial market stabilization role of monetary policy, which of course was most urgent in the initial months of the pandemic in the spring and summer of 2020, and is a substantial contributor to the ample monetary accommodation required to counter the negative impact of the pandemic on inflation dynamics. The PEP is a particularly effective and efficient program for ensuring that the critical middle and long end segments of the yield curve components of overall financing conditions remain appropriate. The most recent macro projections suggest that any premature steepening of the yield curve would not be conducive to countering the negative pandemic shock to projected inflation path. More generally, our commitment to employ the PEP to preserve favorable financing conditions throughout the pandemic period represents a significant easing of the monetary policy stance and thereby boosting inflation expectations through the forward guidance it provides. Finally, the revisions to the TLTRO III program have also played a central role in easing bank funding conditions in a manner that protects the supply of credit to firms and households. There is considerable uncertainty about pandemic dynamics. The recent intensification of the pandemic in many countries and the associated containment measures represents a significant downside risk and also requires the prolongation of various fiscal support measures. At the same time, the launch of vaccination campaigns is a milestone in the eventual resolution of the pandemic health crisis, even if there's only cloudy visibility of the calendar towards sufficient immunity to enable the restoration of normal economic activity. Under these conditions of high uncertainty, standard pool analysis suggests that the preservation of favorable financing conditions calls for a two-sided and flexible approach to the total scale of asset purchases under the PEP. If favorable financing conditions can be maintained with asset purchase flows that do not exhaust the envelope over the net purchase horizon of the PEP, the envelope need not be used in full. Equally, the envelope can be recalibrated if required to maintain favorable financing conditions to help counter the negative pandemic shock to past inflation. Now, looking beyond the pandemic period to the longer run, the future orientation of macroeconomic policies will need to meet several challenges. In thinking about the new steady state, let me emphasize that the implications of low equilibrium real interest rates for fiscal policy and monetary policy is a first order issue. In relation to fiscal policy, this applies both to reviewing the conditions for fiscal sustainability and the appropriate role of fiscal policy in macro stabilization. In relation to monetary policy, the decline in the equilibrium real interest rate is a central topic in our ongoing strategy review. So let me stop there, and of course, I'm sure we can come back to some of these topics in the subsequent round. Thank you.
Thank you very much, Philippe. Let's ask Jacques.
Yes, thank you very much, and thank you, the Central Bank of Hungary, for having invited me. It's a pleasure and an honor. I'll make 5 brief points. Firstly, there is great applause for the swift and massive action taken by central banks in providing needed liquidity to economic agents just after the outbreak of the pandemic. A collapse of our economies was thus avoided. Once again, central bankers were seen as heroes. Second point, but if we want to examine seriously the subject of this conference, that is the future of monetary policy, we must not forget that it is the very accommodative stance of monetary policy over the last 15 years or so that has favored the over-leveraging of our economies. You know that global indebtedness has now overtaken all past peacetime records. The rigid and to me incomprehensible application of the 2% inflation target, while equilibrium inflation is more around 1 to 2%, has led to unnecessary easing. Thirdly, my point is that through the present monumental program of purchases of sovereign securities, central banks have become de facto the agents of fiscal policies. Without the systemic buying of public bonds, which is tantamount to more than 3/4 of new issuances that will be financed by central banks in 2020, 2021 in the Eurozone, governments would not be able, barring increasing spreads, to finance vast stimulus plans. Fourthly, the consequences of such policies should be assessed in the long-term perspective, as suggested by this conference. Two major monetary elements arise. Firstly, zero or negative interest rates are the result of heavy central banks' purchases. If we have to reflect on the issue of the long-term consequences of durably zero interest rates. And secondly, markets are de facto bypassed by central banks. Of course, the textbook says that central banks buy on the market, but the markets know that, and it takes into account, since the purchases come immediately after the issuance to the market. And lastly, for the post-COVID future, we have to consider at least three issues. Firstly, should the financing by central banks of all fiscal deficits be continued in an unlimited fashion in the future? What would such a permanent policy mean with regard to monetary stability and to the desirability of leaving sufficient incentives for fiscal reform, especially in countries with overextended positions? Has fiscal dominance become the rule? Secondly, is it good to peg the market prices and therefore the interest rates of government securities for an indefinite period? Do we want to eliminate the quote-unquote normal differences of risk evaluation that markets usually display between different signatures? Should central banks decide and dictate the whole yield curve for all the so-called riskless instruments? And lastly, we are told inflation is not a risk. On the contrary, it's too low. We need more inflation. We need more fiscal stimulus to beef up the economy. Is this really convincing in the long run? Personally, I doubt it. Indeed, zero or negative interest rates for too long have major drawbacks. They trigger the liquidity trap phenomenon. It is a fact that economic agents prefer keeping their savings in extremely liquid forms like bank deposits, while they are not tempted to buy long-term securities that produce no returns but some risks. This liquidity trap, which was feared by Keynes, is one of the reasons for the decline in productive investment that has been observed over the last 10 years. We should be very careful not to jeopardize our growth by fixing interest rates at too low a level. Of course, natural interest rates are on the downside, but fixing them is another matter. Our future is at stake, and the lack of inflation is misleading. In fact, if consumer prices are stable for the time being, it is not the case of financial assets that are inflated by central banks' purchases. Asset bubbles are indeed a form of inflation that can generate at any time a financial crisis. Thank you for your attention.
Thank you, Jacques. With your long experience as a central banker, and you suggest you have drawn attention to some of the long-term issues. We will come back to that during the discussion, but let's hear now Dr. Yao.
Yeah, it's my great honor to be invited to this distinguished panel of discussion. I would like to follow the previous panelist to talk about the long-term effects of the expansion of liquidity in the world. I was struck by the two figures presented by our chair of this session. The question is, to me, were this kind of expansion result in crisis and also super financialization in the world? And what are the long-term consequences of this super financialization? Right? When the central bank increases liquidity, the central bank will always have in mind that in the future, they can just draw money back if they want. But history tells us it's very difficult for the central bank to shrink the balance sheet once it has been expanded, right? So it seems that those excessive liquidities are going to be there for a long time. Right? So we have been seeing that the inflation rate in the real economy has been kept very, very low. I think one of the main reasons, was that the linkage between the financial sector and then the real economy are getting weaker and weaker, which means the financial sector itself is becoming kind of a self-sustaining economy. Okay. But that's going to have a huge implication for the economy. Right? One of the implications is that if we have an ever-growing financial sector, then it's going to require the real economy to move to higher and higher returns sectors and the technologies, right? And the consequence is that, of course, on the one hand, you're going to have a high innovation, but on the other hand, you're going to have a hollowing out of the manufacturing sector. I think this is a straightforward logic, right? So suppose a bank issue a loan with interest rate of 5%, and then it wants to divert its risk, so it makes a lot of derivatives, right? But the real return is just a 5%. But if you have a larger and a larger financial sector, then that means this 5% is going to be divided or shared by many and many financial institutions. That's going to drive the economy to move to a higher return technology sector, say 8% or 10% return to sustain a growing financial sector. And then gradually the economy gives up the ordinary manufacturing companies, right? I think that's what has been happening in the United States. In the case of Japan, I don't know how the Japanese government is going to repay this huge amount of debt, right? It's approaching 300% of the GDP. And Japan does not have real inflation, right? So to me, I think using monetary policy to stimulus the economy probably is a wrong tool because it's going to only inflate the size of the financial assets. So in this case, probably the fiscal policies are going to or should play a much larger role. First of all, it's very direct, right? So if you collect money and then you spend money, then you're going to boost the economy, okay? And second, it's not inflationary, and it's not going to inflate the financial sector, right? So that's why I quite agree with Dr. Gang Yi's comments about China's monetary policy. Even in last year, when the economy was in a real downturn, the Central Bank of China has been quite cautious in its monetary policy, right? But on the other hand, the government was quite aggressive in spending or in increasing its spending, right? Last year, the total debt raised by the government was over 8 trillion. It comes to how much now? About 1.5 trillion US dollars. And that had a direct impact on the economy. China maintained last year had a growth rate of 2.3%. About half of that growth came from investment, another half probably came from export, right? So investment conducted by the government really played a role to boost China's economy, right? So come back to my initial comments. I think in the long run, monetary policy is going, or this round of monetary expansion is going to create many risks in the economy. I fully agree with the previous speaker, that is the whole world is accumulating huge risks in the financial sector, and we have to be prepared for some kind of crisis in the future. Okay. Thank you. Let me stop here.
Thank you. Now we will ask Bill, who has an experience of a quarter of a century at the Federal Reserve. So let's see what you think about what's going on now and what we should expect in the future as far as monetary policy is concerned. Bill.
All right, thanks very much for inviting me to participate. It's a real pleasure to do so, or even if virtually. And I think it's a great question for the Lamfalussy conference to focus on what we've learned about monetary policy and how it can be improved, since these are topics to which he dedicated much of his remarkable life. So I'm grateful to the organizers for inviting me to participate today. Let's turn to my first slide, please. Next slide, please. Thank you. So at the outset, I think it's important to point out that at least for the United States and other advanced economies, I think the situation is somewhat different, actually, in emerging market economies. The COVID crisis hasn't really changed the already very difficult issues faced by monetary policymakers. Many of the trends that Georgie showed earlier were underway prior to COVID. What the COVID crisis has done is emphasize that the lower bound on nominal interest rates is likely to be a constraint on countercyclical monetary policy for the foreseeable future. And so it encourages policymakers to work on developing appropriate responses to that kind of underlying fact. As all of you are likely aware, and is shown in my chart here, the ECB and the Bank of Japan never did actually lift off following the Great Recession. The Fed did, but it only got rates to about 2.5%. before cutting back to zero last spring in the face of the COVID crisis. Next slide, please. It's worth thinking just for a minute about why the lower bound has loomed so large. There are two broad reasons: low equilibrium real rates, the so-called R star, and low actual and expected inflation. As shown in the left panel here, R star has been falling for some time. There's been a lot of work done on that. There are a number of secular trends driving that: lower gains in productivity, shifts in international saving behavior, aging populations, and others. And the lower and more stable inflation that you can see to the right reflects, at least to a large extent, the success of central banks in achieving their inflation objectives. So going forward, what should we expect? It's possible that R star will increase again. That could happen, for example, if productivity growth picks up in the face of new technological gains, for example, or as a result of continued demographic shifts, as Charles Goodhart has emphasized. And of course, it's possible that inflation will rise. Indeed, in some cases, such a rise would be welcome, just to get inflation closer to target. But inflation expectations have been low and stable in the face of the Great Recession. Seems likely to me they'll remain low and stable going forward, even if there is some sort of COVID-related jump in inflation this year. I think it's likely to prove transitory. So we're just living in a world of very low nominal interest rates. I think that's not likely to change anytime soon. And the COVID crisis, if anything, has made this problem a little bit worse, since the possibility of such pandemic events is now more salient. And so it's likely boosting desired saving, at least some, and that puts some further downward pressure on R star. Let's turn to the last slide, please, on the implications for monetary policy. First, I think this background puts a focus on unconventional monetary policy, since conventional policy is going to be constrained in downturns. There are a number of possibilities. One is negative interest rates, but the existence of currency means that, at least for now, there are limits to how low you can go. And this is, I think, now pretty well understood. There are potential costs and risks to moving rates to negative. And so there are real constraints here. And indeed, the Federal Reserve, at least, has decided to not use negative rates at all, given those costs and risks. A second sort of unconventional policy is what you might think of as conventional unconventional tools, forward guidance and large-scale asset purchases. These have been implemented in many countries. But such policies, I think, also are limited. They operate by pushing down longer-term interest rates, but the lower bound presumably applies to longer-term rates too. And so it isn't clear how far you can get with these policies. And finally, there are a range of potential programs to boost lending to businesses and households. For example, the central banks can provide low-cost funding to encourage banks to lend more. Or more directly, central banks can go out and purchase corporate securities and so improve financing conditions for businesses. And potentially, central banks can even lend directly to businesses, as in the Fed's Main Street Lending Program. But I think even these programs are subject to some limits, unless they are turned into what are essentially just subsidy programs, either for banks or for borrowers. And that seems to be more of a fiscal action than a monetary action. And so I think there are limits to monetary policy, even unconventional monetary policy, and so they may not be enough. A second type of monetary policy adjustment to these challenges caused by the lower bound is a change in the monetary policy framework. These generally involve a shift to what are called make-up strategies, under which the central bank commits to maintaining easy monetary policy for longer once the economy recovers from a downturn, in order to offset the effects of the lower bound and build in expectations for lower rates and higher inflation, and thereby boost spending in the downturn. At this point, we simply don't have a lot of experience with these policies. They look good in a range of models, but it's hard to be confident. We'll learn more about them as they're implemented. The Fed last summer announced its new flexible average inflation targeting framework, And perhaps other central banks will follow with adjustments to their frameworks. So we'll see, I think, how effective these policies may be. But there are reasons to wonder if such policies will be very powerful, because their power depends in large part on them being well understood and seen as credible by the public, as well as on the public being very forward-looking in decision-making. And these are things that are hard to be confident about. So if monetary policy is likely to be constrained by the zero bound and the limits to unconventional policy, it may be that we need to consider how better to coordinate monetary policy with fiscal policy. That is, how can we get the policy mix better? Indeed, with monetary policy constrained, we're going to need more active countercyclical fiscal policy to keep the economy on track, as Yang noted. And we have seen aggressive and effective fiscal policy in response to COVID, as several people have noted. That's good news. That's been effective. And monetary policy can help support such fiscal policy in a number of ways. First and most obviously, monetary policy can help create some fiscal space by keeping interest rates lower than would have otherwise been the case. Second, monetary policy can back up the fiscal authorities if there's a loss of confidence, as there might be with high levels of debt, which we certainly are seeing. Doing that can help avoid expectational crises. And we've seen how this can work effectively with the whatever it takes statement by Mario Draghi now quite a while ago. And of course, ultimately, monetary policy can support fiscal policy with direct monetary finance of deficits with seniorage. Models suggest that can be very effective if it's understood and credible. And of course, historical experience, particularly in the case of wartime, also suggests that money finance can support high levels of production and higher inflation. Indeed, the result by design is higher inflation. So a little bit is going to go a long way. And if the central bank lacks independence, money finance could be very attractive, indeed all too attractive to the fiscal authorities, and so result in very high and persistent inflation, which would make the situation worse rather than better. So if there's a possibility of going in this direction, then we really should think in advance about the institutional arrangements needed to ensure that the central bank remains independent and can say no to monetary finance when it's not appropriate. Otherwise, the outcomes are likely to be worse rather than better. So I'll end just by noting, I think it's appropriate, given that this is the Lamfalussy conference, that we need once again to think about the institutional structure for monetary policy making as he did in his career. And we can do so in a way that could make monetary policy more effective post-COVID. Thank you very much.
Thank you, Bill. What's interesting now that it looks like central banks are trying to figure out exactly what strategy to follow. The Fed has inflation target averaging. The Bank of Japan has yield curve control. The ECB is still inflation targeting, but with some comments next to it. They are looking at lending rates, corporate credit conditions, government bond yielders are favorable enough to boost demand and inflation. So they sort of qualify this with a number of statements, which is understandable under the current circumstances. But looking forward, I would like to ask a couple of questions. One is, what do we think of inflation target averaging? Jacques, if you could tell something about that.
Well, it's very difficult to answer that question. Inflation is, if you calculate it through consumer price indexes, is low because there is some long-term structural tendencies which do act towards lower inflation. You have the aging of the population, you have less activity that is related to that demographic situation. So there is less excitement in the general economy, which usually produces inflation, and there's a lot of slack. So that's the sort of structural part. Now, if monetary policy is extremely lax, and if all deficits are financed by money creation, one day we will have inflation because of the sheer magnitude of the liquidity creation versus the supply. So it's not something that is visible today, and wages are still in real terms rather moderate in their growth. But if things go to the exacerbated limits or no limits of monetary policy, you could have inflation. And we already see some little signs of that in different sectors. So I think inflation is something we have to think about, even if it is not in action today. But then we have the other inflation, which we tend to turn a blind eye to, and that is the inflation of financial assets and real estate assets. And that's a form of inflation, because anything that goes much farther than I would say, the fundamental elements of prices is a form of inflation. And I'm always a bit surprised, because central banks are proud to having a moderate inflation. They would like it a bit higher, but they're sort of okay. And they never say that shares, that bonds, that real estate, other raw materials are the object of inflation. I'm always surprised about that.
Thank you. Jacques, you said or wrote somewhere about inflation averaging. You gave an example saying that a person goes to a doctor and the doctor says, nothing to worry, your average temperature was below average, so we will just average it out in the future. So that's a good way for me, it was a good way for me what you thought about inflation averaging. Philippe, can I ask you that, what do you think of inflation averaging or yield curve control? Is that something that could be the future strategy after COVID also?
Well, I think the way I'm going to phrase it is all of this comes back to how Bill English presented, which is the implication of a low equilibrium real interest rate and already low inflation, which basically means there is a lower bound issue. And that lower bound issue is asymmetric, which means, if you like, if you don't think about ways to kind of make sure inflation spends most of its time in the neighborhood of the inflation target, you're going to have, if you like, the presumption it's easier to fix high inflation than it is to fix low inflation. And so these ideas about flexible average inflation targeting and so on are really ways to explicitly deal with that asymmetry. You know, obviously, we're saying we leave no stone unturned in our strategy review, but this issue of the lower bound, the issue of the asymmetry, and the issue about the different ways. I mean, in principle, there are different ways to respond to that, of which the Fed has picked one. But we're currently in the middle of it in terms of looking at all the different ways you can think about it. But I do think you have to confront it. You do have to recognize it. You do have to deal with it. But the precise way, let's see. But let me come back. I mean, this pervades so much of the discussion, which is, do we accept the implications of low equilibrium real rates, which in turn, as several of the contributors and earlier on in the opening remarks, do we accept it? Do we accept that there are, if you like, global forces and European forces, which mean that the level of desired saving, if you like, is high relative to the level of desired investment. Because in that world, if that is accepted, for example, the fact that there's been a significant rise in asset prices, the line of causality there is simply the fact that the world has accepted that the steady state discount rate is lower than it used to be, and therefore the appropriate value you put on assets has changed. I mean, if you look at a wider set of indices comparing asset prices to discount rates, looking at the role of credit and so on, you know, I think it's very important to study under what conditions is this simply a repricing versus under what conditions is this, if you like, kind of some distortion coming from liquidity. Yield curve control, if you like, is another way to think about it. As Baron said, you know, that essentially if you've constrained at the short end of the curve, you can do different things at further out into the curve, the medium and long end of the curve. And one way to do that is with yield curve control, but it's also through forward guidance and asset prices. But I think probably in the end, all of these are, if you like, confront the same basic issue, which is if you do have a lower bound and if equilibrium real rates are low, then you need to find answers. And I think the answers are revising how we do monetary policy. And as I indicated in my own remarks, it's also answers about rethinking the role of fiscal policy. And if you like, I think always when people raise concerns about the configuration we have, which does definitely include a lot more leverage than before globally, is what is the counterfactual? I mean, I don't particularly see, you know, what would be helped if central banks decided, well, low interest rates are damaging, let's raise interest rates. If equilibrium forces are saying that the only way the world economy can operate is with very low real rates, if central banks try to lift rates ahead of that, I'm not so sure it's going to help matters. So again, maybe my rambling answer just comes back to the basic point, is it's a pretty pervasive, all-encompassing, multi-dimensional issue, the implications of low equilibrium real rates for macro policy, macroprudential policy, the operation of the financial system. You know, it's pervasive as opposed to being just an issue for central banks to deal with.
Thank you. There is now a huge buildup of liquidity in the hands of the private sector. Henry Wallich, a former member of the Fed's Board of Governors, once said, inflation is a monetary phenomenon like shooting is a ballistic phenomenon. Do we still believe in that? Who would want to comment on that?
I'll take a shot at that, and then others, no doubt, will have their own views. But I think that you have to be careful to make a distinction between the size of the central bank's balance sheet and the stance of monetary policy and the central bank's policy reaction function. What we have learned in the last decade or so is that central banks can implement monetary policy with big balance sheets or small balance sheets. The Federal Reserve went through a long process after the asset purchases of the Great Recession period, and figured out, in some sense, how to raise rates even with a large balance sheet. So while it is true that the Fed's balance sheet is large and the stock of reserves is large, that doesn't mean that the Fed can't implement a monetary policy to maintain low and stable inflation. It has tools, payment of interest on reserves, the overnight RRP program, and so on, that allow it to implement monetary policy with a larger or smaller stock of reserves. And so I think you need to make a distinction between perhaps measures of money like M1 or M2 or something like that, where there may be links still to inflation, versus currency and reserves, which I think that link really is broken now, given the tools that central banks have to implement monetary policy.
Thank you. Let's take a question from the audience. Do present circumstances lend credibility to modern monetary theory, suggesting central banks should issue currency massively to finance fiscal responses, or should MMT, in Larry Summers' phrase, still be regarded as voodoo economics? Who would want to answer that? Maybe let's try the Dr. Tao. You, Dr. Yao, why don't you? So the question is, would, let me try to rephrase it also. Are we in a new norm where government will expect central banks to continue to finance their fiscal deficit? Will central banks be able to resist? Is there a danger that central banks will lose their independence? So this is sort of the fiscal role of the central bank.
There is also a debate inside China too. Last year, there were people who strongly argue for MMT as kind of a new theory to expand monetarization of physical deficits. But history tells us that's going to be very, very dangerous. China invented cash, right, paper money in Song Dynasty. But then in Yuan Dynasty, the dynasty just after Song Dynasty, printing money became a way for the government to raise funds. But that became one of the reasons why Yuan Dynasty failed. And we also had this hyperinflation during the Civil War in the late 1940s. So those were the lessons that we have to learn from, right? In the end, it's just about government discipline, whether you are going to constrain yourself to borrow real money, I have to say real money from the people, and then you repay those debts by real income, that is tax income, right? So if the government can just resort to central bank money to finance its spending, there will be no discipline. And in the end, we're going to just repeat historical failures. MMT is not a really stricter theory. It's just a bunch of suggestions or conjectures. So I don't think it's theoretically well-founded. So in that sense, I tend to agree with Professor Summers.
Thank you, but let me come back a little bit to the fiscal. Yeah, Jacques, you wanted to say something?
No, I just wanted to say that this modern theory, I think, is completely mistaken, because it gives the impression that fiat money can create wealth and more goods. And in fact, it doesn't work that way. You could create more money, you can create more liquidity, but you're not going to enhance investment and growth. And that's what puzzles me in the present situation. The fact that one can create a lot of money with zero interest rates is actually, I did some studies on that with an organization that I created a few years ago. In fact, this is creating more liquidity, more preference for liquidity, more increases in accounting banks and things like that, and not real investment, because real investment carries risks. And if you have a zero or even a negative return, and if you are a rational economic agent, you're not going to put your money in a long-term investment that carries some risk if it has no return at all, like our Chinese friend said, he said, the world has to turn towards more rewarding, more high-yielding real investments. And so people are discouraged from investing in long-term because there is no reward. And if you look at the evolution of the financial savings of households in European countries, which I have been studying, you see an exponential growth of the most liquid part of that, which is banknotes and bank accounts, sight accounts. And of course, the impact of accounts in banks on investment is very different from the one that could emanate from buying long-term bonds that are related to productive investment. And this is one of the reasons why productive investment has been dwindling over the last 10 years. Instinctively, you would say with zero interest rate money that you can access very easily, you're going to invest long term, and it doesn't work that way. So I think it is a mistake to tell people that interest rates are going to remain very low for very long, because it creates a sort of a depressive mindset. If you say to someone that interest rates are going to remain zero or negative for, I don't know, 10 years, if you say that, it's tantamount to saying there's going to be no growth. And so it's a very depressing mindset. I think interest rates are basically going to be low for structural reasons that I mentioned a moment ago. But don't force them to be even lower through discretionary actions in monetary policy. I'm very opposed to the idea that a central bank could tell us what is the interest rate that is the one of a 10-year, 20-year, 30-year instrument. I think it's not the job of central banks, it's the job of markets. And so I'm a remnant of the old economy. I believe in financial markets. I believe that they should be able to discriminate between different risks and signatures. And I'm not so sure that creating a mold where interest rates are fixed on all the curve, all the yield curve by respectable people in central banks, of course, but by people who haven't, are not equivalent to the market itself, are mistaken. So I'm very much reluctant or skeptical about these things. And when I'm told again and again, yes, but you have the zero bound. The zero bound has been created by us. It is because we've had such a accommodative monetary policy that we've been buying so much securities to central banks that interest rates have gone to zero. And now we say, yes, but they are at zero, so we have to imagine something else in order to recreate a autonomy and efficiency in monetary policy. I really think the world is walking on its head. We have created too much liquidity. We have been accustomed to the idea that the expansion of credits in all their forms had to be 2 or 3 times the expansion of the real economy. In history, it wasn't that way. The increase in financing and credit through banks and markets was always at the pace, more or less, of the increase in the real economy. And now it's 2 to 3 times more. So we are creating a financialization of the economy. And at one point, it's too much over leveraging and we fall into a crisis. So it's a very dangerous situation. And then you have all these zombie companies that live because one gives them the subsidy of very low interest rates. And this is altering the conditions of an efficient economy. I'm very much at ease. I was a central banker myself, and I knew that I could act on the short-term part of the yield curve through monetary actions, and that was okay. But I never thought that someone would ask me what should be the interest rate of an asset at, I don't know, 17 years. I would have said, you're crazy. You're asking me. Ask the markets. So I believe that we have to regain some modicum at the beginning form of normality and allow long-term interest rates to take their dimension and not believe that monetary ease will take care of everything, take care of climatic investment or whatever. I mean, the economy doesn't function like that. You need to reward risks. You need to have enough investments that go towards risky investments. Now, the American economy is much better placed in these respects because they have a reactivity to innovation. They have also a very strong market for equity, which we don't have in Europe. But
Jacques,
we have to.
Jacques, can you
have to come back
make it shorter so that we can ask the others? Thank you very much. Thank you. In fact, what you said is it can be rephrased a little bit that easy policy may suppress Schumpeterian creative destruction. Basically, you did say that that is an issue. That is an issue. That brings me to this R minus G issue, is that inflation may pick up. We don't know. But more importantly, with low investment and productivity growth, the prospect of G dropping below R is not to be ruled out, and R minus G may become positive, which will be an issue for debt servicing. Can I ask Philip, who you worked on fiscal issues, I remember, can you comment a little bit on this R minus G issue and how long we can have confidence in that it will remain negative and this huge increase in debt will not create debt servicing issues? Philip.
I think, and the way I wrote the last part of my contribution was to emphasize not only what we expect. So I've talked a lot about the low equilibrium real rate, which basically may be based on averages, but also the distribution. Because I mean, there's a lot of uncertainty about the distribution of future interest rates and distribution of future growth rates, for that matter. And maybe I'll sidestep a little bit, because probably whether R is greater or less than G is not the most important point, because you know, if the growth rate is above the interest rate by a little bit, or the growth rate is below the interest rate by a little bit, it definitely has implications. But we have to remember, most likely the primary balance, the primary surplus will respond. I mean, I think if you look at European governments over the last 10 or 15 years, it's not the case the primary surplus is invariant to the interest rate they pay or to the growth rate of the economy. So it's probably, if you kind of say, well, the path of primary balance is invariant, this is a big issue. But the extent that path of primary balances will respond, you know, I don't think it's the most important issue. But what is true is some of the stories behind low equilibrium real rates are not so benign. As you indicated, one reason why interest rates could be low is low productivity growth. So if you have low productivity growth, then the kind of prospects for how governments are going to pay for an aging society, the prospects how governments are going to pay for healthcare, for pensions, you know, there's a lot of challenges there because tax revenues are not going to grow so quickly over time. I mean, it goes back to all of the unfunded liabilities out there. If you built your economy, if you built your pension system around a certain growth rate of the economy and that doesn't pan out. Another basic issue is, and this goes back a little bit to the desire for safe assets. Why do people want to hold safe assets as opposed to take on more risk? In part, that's a reflection of it turning out the world is more risky than some people believed. We had the global financial crisis. We now have a pandemic. We have climate change risk out there. And the paradox is all of these are probably pretty expensive fiscally. Governments will need to do a lot. They need to do a lot in terms of protecting societies from those risks. It's probably efficient to have a lot of social insurance rather than ask individuals to privately insure by accumulating buffer savings. And so in those contexts, if you tell me there's going to be a low equilibrium real rate, it's not all that reassuring for fiscal policy if one of the reasons behind that is there's a lot of big challenges out there which require the government to spend more. And on a smoothing basis, may well need to run larger surpluses or smaller deficits. So, you know, I think, you know, in the end, I mean, going back, I mean, it's a pervasive issue, but it's not a simple issue. So I think that having any kind of knee-jerk response to the connections between the interest rate to growth rate and the appropriate stance of fiscal policy, you need to go into the individual elements of that. And what I tried to indicate to you, for example, with this pandemic, yes, there's been a very large fiscal response, but that's only in part because fiscal balances were in sufficiently okay shape going into this, that there could be a big expansion without triggering a kind of rising risk premium. And so, if you like, in terms of coming out of this, at some point, getting these debt ratios to decline again would recreate fiscal space that we may need in the future. This may not be the last big crisis the world faces. And so restoring fiscal space will be an important challenge in the coming years.
Thank you, Philip. As the saying goes, spend, but spend well. Now we have quite a few questions, which shows the interest in the panelists. Let me ask one. Are central bankers doing enough to explain to ordinary citizens what they are doing? How might they improve their communications with the public? Now I am asking someone who is not sitting as a governor or as a policymaker. I will ask Bill, what do you think?
So I think it's a great question. And what the Federal Reserve has always said is we explain as clearly as we can our policy and our policy aims, but it's hard. I mean, it really is difficult, and communication about monetary policy is tricky because many of the arguments are simply complicated, and you have kind of different parts of the public to which you need to communicate differently. The Bank of England, I think, has a good approach to this. They have explicitly kind of layered communications, where they have relatively simple communications for the broad public. They have more detailed communications for example, for the press, which then can go on and explain to the public, and then very detailed discussions in their inflation report, for example, for people who are specialists. But I think it is difficult, and particularly when it comes to unconventional policy, where, as I said in my contribution earlier, a lot of the power comes from expectations that people understand what the central bank is saying, they find it credible, and so they react in a forward-looking way. Communications really is central to the effectiveness of monetary policy, and so I think this is an issue where central bankers need to do work on how to communicate more effectively and how to communicate more clearly to make policy more effective. And just a final thought, also to make policy more accountable. Central banks are independent institutions. They're taking very dramatic steps sometimes, and they need to be accountable for those steps. And so communication also is a way of contributing to the accountability of the central bank, which I think helps to ensure that the central banks remain independent.
Yeah, I guess when central banks have now a role of rebooting the economy by various new measures, it's much more difficult to communicate to the public in those circumstances. Now, there is another question, and that would be the last one that I would like to ask, and this is to Philip. I read the question. Mr. Lane nicely elaborated on the support of ECB, on the support that ECB has provided to markets and companies by providing liquidity and easing of credit conditions during the pandemic. But an important element of the ECB's measures was also the stepping up of bilateral liquidity lines to other central banks. Could Mr. Lane perhaps comment on the future of these arrangements as they have become an important part of the global liquidity safety net? That's an interesting question.
So I'm not precisely going to comment about the precise future, because, but the general point is well taken, that essentially we do have the experience now. Of course, it's very important, given so much of the global financial system is denominated in dollars. It's very important that the dollar, the Fed did what was needed in terms of swap and repo lines. But it's actually, we definitely found that it's important for us to do something similar, that the euro is an important reserve currency. Euro, and in particular, and the reason why you need these liquidity and repo lines is you have financial systems in the broader European region which hold a lot of euro-denominated bonds. And so essentially in that situation, it's in the self-interest of the ECB to provide liquidity, because the alternative way for these systems to raise euro liquidity would have been to sell these longer-term assets, and that would have been disruptive. So it's very much a very interesting and practical recognition that, if you like, it's a win-win situation, subject to all of the usual risk controls. It's important for these countries to not so much that they need to draw down necessarily all the time these agreements, but the option is there, it's a backstop. But it's also useful for the ECB in the same way I'm sure it's useful for the US, that it's a stabilizing a system, because the alternative is just more forced selling, if you like, into the longer end of the bond market, which would not be helpful under conditions of stress. So given that setup, it goes hand in hand with, I suppose, this issue of using asset purchases, using QE, trying to extract something from of value from pushing down term premia, even if there's clearly a hierarchy where, compared to the short end, it's only a marginal contribution. But yeah, so I think the question does very much strike to the situation. The conditions we're in now do make it important that we have a rigorous system. We put a lot of work into designing that system, because there's clearly a lot of factors to consider. But I think it was a success story of 2020 that was set up.
Thank you, Philip. We have arrived to our to the end of the panel discussions. Nobody reacted to my question whether we would need a Bretton Woods 2.0 for the after-COVID international monetary framework. But let's talk about that another time. And thank you very much. Thank you, Philippe. Thank you, Jacques. Thank you, Dr. Tao. And thank you, Bill. And I hope that next year's Lamfalussy conference will be offline, which means also that we have tamed the pandemic. Thank you very much.
Thank you.
Dear panelists, thank you all for the very dynamic and insightful discussion. It was very rewarding and illuminating. I believe we can all agree that despite the difficulties and the challenges we are facing now due to the pandemic, there is still a hope that our lives will return to normal soon, as policymakers and professionals are doing their best to navigate us back to our pre-crisis lives. Ladies and gentlemen, with the closing of our panel discussion, our program is coming to its end. I would like to ask Deputy Governor Mr. Barnabás Virág to come to the stage again to close this year's conference and summarize the key takeaways from today's discussions. Deputy Governor Virág, the floor is yours.
Honorable guests, dear colleagues, ladies and gentlemen, on behalf of the entire audience, I would like to thank you for honoring us with your participation in the 8th Lamfalussy Lectures E-Conference. Despite the unusual circumstances, we have had fruitful discussions about the future of monetary policy. Today's speeches and the panel discussions once again justify that difficult situations inspire innovative thinking, and by this, we can benefit from the recent period. The speeches we have heard today were excellent and fascinating. We are especially grateful for this year's Lamfalussy lecture given by Governor Boris Vujicic and the keynote speech of Governor Gangier. The thoughts and ideas that were shared today confirm that a new age of central banking is at our doorsteps. As the Great Recession did, Covid-19 also marks a milestone of a change. But the nature of change is different this time. We should take the opportunity and start building a better future now. Central banks can mainly contribute to this in 3 ways, as highlighted previously today. First, a closer cooperation between fiscal and monetary authorities ensures that the right policy mix is applied at all times. The economic backlash caused by the COVID-19 was successfully mitigated by taking the correct steps in the correct order. Governments and central banks should keep working together should there be a similar event in the future. Second, a larger balance sheet will also enlarge the monetary policy room for maneuver. To mitigate the adverse financial effects of the pandemic, central banks have intervened quickly and decisively. Consequently, balance sheets have reached record highs. However, this does not mean that central banks have run out of ammunition. On the contrary, it shows how much central banks can do to support the economy. Keeping this in mind, negative repercussions can be handled in the same manner should further increase arise. Third, finally, a continuous presence in the government securities market improves monetary transmission and ensures that interest rates remain persistently low. This will be of special importance in the forthcoming period, as maintaining sustainable government budgets will receive greater attention. Once economic growth is reinstated, our focus needs to be shifted on the restoring balance. Lasting government bond market presence coincides with a larger central bank's balance sheet. This also provides further opportunities for supporting sustainability. Central banks can support the issuance of green bonds, which contribute to sustainability from the side of real economy. On the one hand, such purchases incentivize businesses to conduct greener practices, while stimulating the market for green bonds too. Larger balance sheet also allows central banks to further embrace digitalization. Implementing digital innovations can greatly improve efficiency and in turn the allocation of our increasingly scarce resources. A great example of this is central bank digital currencies, which just might be the basis of our payment systems in the future. Finally, +1. As the Lamfalussy Lectures Conference demonstrates, central banks can not only be pioneers in practice, but also in theory. Our fellow guests have proven that a new age of thinking has started worldwide. Events such as the annual Lamfalussy Lecture Conference provide a platform to share and further develop such ideas. Finally, I would like to thank the audience and the speakers for joining this year's conference online. We are looking forward to welcoming you to the next year's Lamfalussy Lectures Conference, hopefully in our usual setting here in Budapest. With this, the Lamfalussy Lectures E-Conference of 2021 has come to an end. I would like to convey my best wishes and good health for our guests and the audience as well. Thank you very much.
Thank you, Mr. Virag. I sincerely hope that everybody found some food for thought from the enlightening speeches and the panel discussion. Once again, I would like to congratulate this year's two awardees, Governor Boris Vujicic and Mr. Gergely Fábián. I would like to thank all our speakers and participants for sharing their valuable insights and our audience for staying with us for the conference. In case you missed any part of the conference or you would like to watch our program again, please visit the Lamfalussy Lectures Conference website for the recording of the entire event will be available. Thank you all for being with us today. Please stay safe and healthy, and I hope that next year we will be able to meet in our usual settings in Budapest for the 9th Lamfalussy Lectures Conference. Goodbye.